Hey there, I'm estate planning attorney Paul Rabelais, and in this video I want to tell you exactly who should and who shouldn't take estate tax planning action prior to January 1st, 2026, when the Tax Cuts and Jobs Act of 2017 is scheduled to expire or sunset. So the estate tax exemption is currently high under most people's standards, but it's about to be roughly cut in half. You see, for people who pass away in the calendar year 2024, they can have an estate valued at up to $13.61 million without incurring the 40% federal estate tax. And since each spouse has an exemption, essentially married couples with some proper estate planning documentation in place can shield twice that amount, or $27.22 million, from the federal estate tax. The exemption will have an inflation adjustment increase in 2025 and then will be cut in half for estates of people who pass away on or after January 1st, 2026. So I've had many conversations with people around the country who have asked me, they've said, Paul, should we do anything special because the lifetime estate and gift tax exemption is changing so radically at the end of 2025? And the answer, of course, is it depends. You see, if Mr. and Mrs. Moneybags, even though it's highly unlikely, both die on December 31st, 2025 with a $28 million estate, their estate tax bill will be zero, since each of them will likely have an estate tax exemption in 2025 that exceeds $14 million. But if they wait one day and die on January 1st, 2026 with that same $28 million, their estate tax bill will likely be more than $5 million. But lots of people who are in the $5 million to $50 million estate value range are asking me, Paul, since this gift and estate tax system is unified and people can use their lifetime exemption either while they are alive through gifts or when they die through passing along an inheritance to their heirs, is there anything I should be doing prior to 2026 to take advantage of this really large $13 to $14 million gift and estate tax exemption? So let's take a closer look at this. You see, I think the key thing that people need to realize is that back in 2019, the IRS issued final regulations to address this issue. And these regulations are known as the Anti-Clawback Rule. And under this Anti-Clawback Rule, a deceased person's exemption will be the greater of the exemption that they used during their lifetime by gifting or the exemption in the year that they died. Let me give you an example. Let's say an unmarried person dies in 2026 with a $20 million estate, and let's say in 2026 the exemption is $7 million, and they had made no taxable gifts during their lifetime, gifts in excess of the annual exclusion amount, which is currently $18,000. Well, their exemption will be $7 million, and $13 million of their $20 million will be subject to the 40% federal estate tax. Now let's change it up a little. Let's say that same individual with the $20 million estate made a $5 million taxable gift in 2024, using $5 million of their $13.61 million federal gift and estate tax exemption. Then 2 years later, in 2026, they died still owning the remaining $15 million. Because the $7 million exemption for 2026 is greater than the $5 million in lifetime taxable gifts that they made, their exemption will be $7 million, and they will have used $5 million of it during their lifetime, shielding only $2 million from their remaining $15 million from the 40% estate tax. Just like in the previous example, $13 million will be subject to the 40% federal estate tax. Now let's change it up once more. Let's say that same individual with a $20 million estate transferred or donated $13.6 million, which happens to be the amount of the exemption for 2024, to their heirs here in 2024. And then they died in 2026, still owning only $6.4 million. Because they made a large $13.6 million gift while the exemption was $13.6 million, and the formula again to determine their exemption is the greater of the exemption that they used during their lifetime, $13.6 million, and the exemption when they died was $7 million, that estate's exemption will be $13.6 million, and only $6.4 million will be subject to the 40% federal estate tax when they die. So, who should take some estate tax planning action prior to 2026? Well, let me break this down in terms that may be easier to understand. And these general guidelines will be for married couples, each of whom has their own exemption. I'm going to give you 3 scenarios and know that, everyone is different. For example, someone may have a $10 million estate today, but next year, because of perhaps some windfall or business success, they have a $50 million estate. Then, of course, we have to revisit that person's estate tax planning options. So first, let's look at the married couple whose combined estates are worth less than $15 million. You're probably not going to take any action as a result of the upcoming sunset in the Tax Cuts and Jobs Act, because to take advantage of the increased exemption that we have for 2024 and 2025, each spouse would need to donate more than $7 million. And then the couple would need to feel comfortable living out the rest of their lives off of the remaining assets. Second, let's look at married couples who have a combined estate of between $15 million and $40 million. Now, if this couple is interested in minimizing estate tax when they die, they certainly would want to consider maxing out their $18,000 annual exclusion gifting. But in order to take advantage of the Anti-Clawback Rule, they would have to give away to their descendants or heirs much more than half of what they own. And some married couples are reluctant to do that for a variety of reasons. They don't want to give up control over half of their estate. They're not comfortable irrevocably dumping a large sum into their children's laps, even though it could be placed in a trust for them. So we're going to have to look at those $15 million to $40 million couples on a case-by-case basis. And third, for those married couples who have a combined estate exceeding $40 million, well, those couples may feel that they can financially swing transferring as much as $27 million to their heirs, while each spouse has an exemption that exceeds $13.5 million. Because that couple wants to take advantage of the large gift and estate tax exemption while they have it, and the couple feels comfortable that they can live off of the assets that remain in their estate. So I think it bears repeating that in order to take advantage of the large gift and estate tax exemption that ultimately gets cut in half in 2026, you have to use it in 2024 or 2025 by making what to many are really large gifts. Remember, when someone dies in the future, the anti-clawback rule says that a deceased person's exemption will be the greater of the exemption that they used during their lifetime by gifting or the exemption in the year that they died. Now, it is possible that Congress acts prior to January 1st, 2026 to extend the Tax Cuts and Jobs Act of 2017 or to make that act permanent. Or the entire estate and gift tax system could be changed, but all of that would be merely speculation. This video is based solely on the laws as they exist on the books today. Have a great day.